The next bull market is coming, and the people who prepare now will make more money in 2 years than most people make in 20. Next bull market will not be powered by short-term hype or speculative momentum. Instead, it will be shaped by massive structural forces that are already reshaping the global economy. These long-term trends are not temporary waves, but deep economic transitions that will influence how businesses operate, how consumers behave, and how technology integrates into everyday life. Artificial intelligence is one of the strongest forces leading this transformation. AI is no longer limited to research labs or tech giants. It is becoming a core component of business operations in every industry, from finance and healthcare to manufacturing and retail. Companies are using AI to automate tasks, increase productivity, enhance customer service, and make data-driven decisions at scale. As organizations race to adopt AI tools, the demand for AI hardware, software, and expertise will skyrocket. Cloud computing will amplify this trend because AI systems require powerful cloud infrastructure for storage, scalability, and processing. This creates a huge growth runway for cloud providers, chip manufacturers, and AI-focused innovators who build the tools that future companies will rely on. The shift toward AI and cloud also marks the beginning of a new era where data becomes the most valuable asset businesses can possess. Cloud computing itself is another unstoppable force poised to drive the next bull market. Over the past decade, cloud adoption has grown rapidly, but globally, we are still early in its long-term trajectory. Thousands of small and mid-sized companies are just beginning to transition their operations online, while large enterprises are increasing their reliance on cloud platforms for everything from cybersecurity to remote work to analytics. Cloud computing enables subscription-based revenue models that are stable, predictable, and scalable, qualities that Wall Street loves during bull markets. As hybrid work, global collaboration, and digital operations become permanent features of modern business, the cloud will act as the backbone that supports global economic activity. This means leading cloud service providers, data centers, managed software platforms, and cybersecurity companies will all benefit tremendously as organizations expand their digital ecosystems. While technology is a massive driver, healthcare is equally important for the future economy. Aging populations in countries like the United States, Japan, Europe, and China are creating a surge in demand for medical care, pharmaceuticals, diagnostics, and long-term treatment solutions. Advances in biotechnology, genetic editing, personalized medicine, vaccines, and medical devices are unlocking new possibilities for extending human life and treating diseases that were previously incurable. The global demand for healthcare is not cyclical. It does not depend on interest rates or market sentiment. It grows steadily because it is tied to human needs that never disappear. Companies that produce essential medicines, innovate through research, or build medical technologies have massive long-term revenue opportunities. During bull markets, healthcare stocks shine because they combine innovation with stability. As the world invests more in disease prevention, chronic illness management, and advanced treatments, healthcare leaders will attract substantial investor attention and push markets higher. Renewable energy is another powerful long-term trend that will shape the next bull run. The world is transitioning away from fossil fuels and moving toward cleaner, more sustainable energy sources. Whether this transition happens slowly or rapidly, the direction is irreversible. Governments are setting ambitious climate goals, companies are investing in green technologies, and consumers are becoming more environmentally conscious. Solar, wind, battery storage, hydrogen, and electric vehicles are no longer niche markets. They are becoming mainstream. As production costs decline and technology improves, renewable energy becomes more profitable and scalable. Meanwhile, geopolitical tensions and energy supply instability are pushing nations to adopt domestic alternative energy solutions to ensure security and independence. Companies that build renewable infrastructure, battery technologies, charging networks, and energy management systems stand at the beginning of a multi-decade growth cycle. As clean energy becomes the global standard, these stocks will attract significant investment and become central players in future bull markets. Digital finance, or fintech, is also transforming how money moves around the world. Cash usage is declining, while online banking, mobile payments, cryptocurrencies, digital wallets, and automated investment tools are rising. Consumers want speed, convenience, and transparency in financial transactions. Businesses want tools that reduce costs, increase efficiency, and improve customer experience. Traditional banks are being forced to adapt, and many are partnering with or integrating fintech innovations to stay competitive. Meanwhile, digital payment. Companies benefit from every online purchase, subscription, and mobile transaction. As more people invest in the stock market, open online savings accounts, and manage their money through apps, fintech platforms gain massive user bases that generate recurring revenue. This shift toward financial digitization is not a temporary trend. It is a permanent evolution that will shape economic activity for decades. It gives rise to more global trade, faster capital flows, and broader access to financial services, making it one of the strongest pillars of the next bull market. Together, these long-term forces, AI, cloud computing, healthcare innovation, renewable energy, and digital finance, are not isolated trends. They are interconnected transformations that reinforce each other. AI requires cloud computing. Cloud computing requires cybersecurity. Renewable energy requires advanced technology and global supply chains. Healthcare innovation benefits from data analytics and AI-driven tools. Digital finance allows businesses in all these sectors to operate smoothly and globally. These industries create a feedback loop of innovation, investment, and growth that will fuel economic expansion for years to come. Investors who recognize this shift early and position themselves before the next bull market fully begins will have the opportunity to benefit from trends that are not only powerful but also inevitable. High-quality companies with strong fundamentals and durable competitive advantages consistently outperform in both downturns and recoveries because they are built to survive economic pressure and thrive when conditions improve. When markets fall, weak companies collapse under debt, shrinking demand, or poor management, while strong companies use downturns as opportunities. They expand market share, acquire competitors at discount prices, improve efficiency, and strengthen business models. This is why long-term investors focus on fundamentals rather than short-term stock price movements. Fundamentals represent the true health of a business: its revenue, profits, cash flow, debt levels, customer loyalty, and ability to innovate. When these factors are strong, temporary market volatility doesn't impact the company's long-term trajectory. Instead, it becomes a chance for disciplined investors to buy more at attractive prices. Companies with competitive advantages, often called moats, can protect themselves from competitors and maintain long-term profitability. These advantages come in many forms. Some companies have dominant brands that customers trust, giving them pricing power even during recessions. Others have vast user networks where the value of the product increases as more people use it. This makes it extremely difficult for newcomers to compete. Some businesses own critical infrastructure or technology that creates high barriers to entry. Others benefit from scale. They can produce goods or deliver services more efficiently than smaller competitors, allowing them to lower prices or maintain higher margins. Regardless of the type, competitive advantages allow companies to stay profitable even in tough times. And when markets recover, they grow faster because they never lost their footing. Strong fundamentals are another essential component of long-term outperformance. Companies with steady revenue, growing cash flow, manageable debt, and healthy profit margins can continue operating without stress during downturns. They don't need bailouts, emergency loans, or massive layoffs to survive. Instead, they can keep investing in research, marketing, and product development. They can acquire undervalued companies, expand into new markets, or double down on new innovations. This resilience is why high-quality companies often emerge stronger after recessions. By the time the next bull market arrives, these businesses are more efficient, more competitive, and more profitable than before, positioning them for rapid growth. Investor psychology also plays a role. During bear markets, fear drives investors to sell stocks, often without considering the actual value or strength of the underlying businesses. This creates opportunities for investors who stay calm and focus on quality. When the market panics, strong companies often become undervalued, allowing long-term investors to buy them at a discount. As the market recovers, these quality stocks rebound faster and climb higher because their earnings and fundamentals remain solid. This pattern has repeated throughout market history. After every recession, crisis, or correction, the companies with the strongest fundamentals always lead the next rally. High-quality companies also attract long-term institutional investors, such as pension funds, insurance companies, and sovereign wealth funds. These large investors look for stability, predictable earnings, and durable competitive advantages. When institutions build long-term positions in strong companies, it creates steady demand for their stocks, reducing volatility and supporting long-term price appreciation. This long-term capital provides stability during downturns and accelerates growth during recoveries as confidence returns to the market. Innovation is another key factor behind the outperformance of quality companies. Market leaders do not stand still. They invest constantly in improving products, expanding services, and exploring new markets. This innovation becomes even more valuable during economic transitions. For example, when industries shift toward digital technology, renewable energy, or automation, the companies already investing in these areas are the first to benefit. Their forward-thinking approach allows them to capture new revenue streams before competitors even react. This ability to adapt and evolve ensures long-term relevance, which translates into consistent stock market performance. Cash-rich companies also have a major advantage during downturns. When revenue slows, these companies continue functioning without relying on external funding. When opportunities arise, such as cheap acquisitions, discounted assets, or talent layoffs at competitors, they can invest aggressively. This is why companies with strong balance sheets often grow faster after recessions. They use downturns as strategic openings rather than setbacks, allowing them to accelerate growth when the economy improves. Customer loyalty is another underestimated strength of high-quality businesses. Companies with strong brands or valuable ecosystems retain customers even during tough times. Loyal customers continue buying products, subscribing to services, or using platforms regardless of market conditions. This creates predictable revenue streams that support the company through downturns. When markets recover, these loyal customers often increase spending, driving rapid revenue and profit growth. This consistent customer base acts as a stabilizer in bad times and a growth engine in good times. Quality companies also invest heavily in talent. Strong leadership teams make strategic decisions that help companies survive crises and thrive during recoveries. They know when to cut costs, when to innovate, and when to expand. Poor leadership can destroy companies quickly, especially during recessions. But skilled management teams protect shareholder value by making tough but necessary decisions. They plan for the long term. This stability attracts investors and boosts confidence during volatile periods. Finally, quality companies build their reputations over time. Investors learn which companies can weather storms and which ones crumble. When a downturn hits, money flows toward safety. companies with strong fundamentals, dependable earnings, and defensible business models. This flight to quality reduces losses during bear markets and sets the stage for strong performance when conditions improve. Then, as optimism returns, these same companies benefit again as investors shift from fear to growth. For all these reasons, companies with solid fundamentals and competitive advantages consistently outperform in both downturns and recoveries. They lose less when markets fall and gain more when markets rise, creating powerful long-term compounding for patient investors. The idea that great investors position themselves during uncertainty, not after the rally has already begun, is one of the most powerful principles in wealth creation. Markets move in cycles, and every cycle has moments of fear, confusion, and instability. When the news is negative, when investors panic, and when asset prices fall, most people run away from the market. But history shows that these moments of uncertainty are exactly when the biggest opportunities appear. Smart investors understand that market fear creates discounts, and those discounts allow them to buy high-quality assets at attractive prices. This doesn't mean timing the exact bottom. It means recognizing that periods of pessimism are temporary, while the long-term growth of strong companies continues for decades. Prices may fall sharply during downturns, but the underlying value of exceptional businesses often remains intact. When the environment stabilizes and confidence slowly returns, the investors who acted early benefit the most. One of the biggest mistakes new investors make is waiting for certainty before investing. They want perfect conditions, positive headlines, economic stability, and rising markets. But by tea time, everything looks safe again. Prices have already risen. The crowd rushes in after the opportunity has passed. Meanwhile, the investors who moved quietly during the downturn are already positioned for growth. They didn't need perfect clarity. They needed patience, research, and the ability to control their emotions. Uncertainty is uncomfortable, but it is also the birthplace of opportunity. When prices drop because of fear rather than fundamentals, long-term investors can build positions in companies they believe in at a fraction of their real value. During uncertain times, the difference between stock price and business value becomes especially important. A company's stock might fall 30% during a market panic, even if its long-term earnings prospects, customer base, or competitive advantages haven't changed. Panic-driven selling creates mispricing, temporary distortions between what a company is worth and what its stock is currently trading at. Great investors look for these gaps. They spend time studying financial statements, business models, and industry trends so they can identify companies that are temporarily discounted. These investors understand that the market is emotional in the short term but rational over the long term. Eventually, the price of a strong business returns to its true value, and those who invested during the decline see outsized gains. Positioning early also gives investors the advantage of compounding. When you invest before a recovery, your capital has more time to grow. Dividends can be reinvested, earnings can compound, and stock prices can appreciate from lower levels. This leads to significantly higher returns over long periods. For example, buying a great business at a depressed price allows your returns to come from multiple sources: valuation recovery, earnings growth, and long-term compounding. This is why investors like Warren Buffett often say that the best time to invest is when everyone else is fearful. Fear lowers prices, and lower prices increase the potential for compounding. Another important factor is psychological discipline. Most people get emotional during uncertain markets. Fear makes them sell at the bottom, and greed makes them buy at the top. Great investors learn to reverse that pattern. They stay calm during panic, stay analytical during market drops, and avoid being influenced by sensational headlines. They understand that short-term volatility is the price of long-term returns. Instead of reacting emotionally, they view downturns as opportunities to accumulate assets. When the market is full of pessimism, they ask a different set of questions. Are the company's fundamentals still strong? Is the long-term story intact? Has the valuation become more attractive? These questions keep them focused on value rather than fear. Positioning during uncertainty also requires a long viewpoint. Investors with a short-term mindset panic when prices fall because they only focus on days or weeks. But long-term investors focus on years or decades. They understand that market downturns are temporary, but long-term growth is permanent. Every major crash in history has eventually recovered and gone on to reach new highs. The investors who held on or invested during those times were rewarded, while those who sold out missed incredible gains. History repeatedly shows that the period right after a crisis often produces some of the highest market returns. But to capture those returns, you must already be invested before the recovery begins, not after. There is also a strategic advantage gained by studying market psychology. When the majority of investors feel uncertain, they behave predictably. They sell emotionally, avoid risk, and hold cash. This reduces competition for high-quality assets, WH, and fewer people are buying. Prices stay low, creating room for disciplined investors to build meaningful positions. Once the recovery begins and confidence returns, the crowd rushes back into the market, pushing prices up. But those who waited for certainty end up buying at higher prices while the early investors are already sitting on gains. This is not just about timing, it's about behavior. Acting rationally when others act emotionally creates long-term advantage. Positioning early also allows investors to diversify at lower cost. During bull markets, high-quality companies often trade at premium valuations. But during uncertain times, even the strongest businesses become cheaper. This allows investors to build diversified portfolios across sectors: technology, healthcare, energy, financials, consumer goods, without overpaying. A well-timed, diversified portfolio can significantly outperform the market once the recovery begins because each sector rebounds differently, creating multiple sources of growth. Another powerful aspect of investing during uncertainty is that it forces investors to focus on fundamentals. When prices are falling and sentiment is negative, emotional investors look for fast exits, but disciplined investors take time to understand which companies truly have long-term potential. They look for strong balance sheets, consistent earnings, loyal customers, and competitive advantages. These qualities help companies survive downturns. When the bull market returns, these same companies often become leaders because they never stopped improving. By positioning early, investors align themselves with the long-term success of these businesses. Finally, great investors understand that uncertainty is not an obstacle, it is a signal. When the market is calm and optimistic, bargains are rare. When the market is chaotic and fearful, bargains are everywhere. The willingness to act during these uncomfortable moments separates average investors from exceptional ones. The market rewards those who can think independently, stay patient, and focus on long-term value rather than short-term headlines. Investors who position themselves during uncertainty are not trying to predict the future. They are preparing for it. Diversification across technology, healthcare, energy, payments, and cybersecurity increases long-term stability because each of these sectors responds differently to economic cycles, global events, and technological shifts. When one sector struggles, another often thrives, creating a natural balance that protects an investor portfolio from large swings in value. No single industry dominates forever. Technology booms, During periods of innovation, healthcare remains strong during recessions, energy cycles with global supply and demand. Digital payments rise with consumer spending and e-commerce, and cybersecurity grows continuously as digital threats increase. By spreading investments across these areas, an investor reduces the risk of being overly dependent on the performance of any one sector, and instead positions themselves to benefit from multiple long-term growth trends at the same time. Technology is one of the fastest growing sectors, but also one of the most volatile. Innovations like artificial intelligence, cloud computing, semiconductors, and automation create huge investment opportunities, yet tech stocks can experience sharp corrections when interest rates rise, regulations tighten, or market sentiment changes. By having technology in a diversified portfolio, investors gain access to high growth opportunities without being fully exposed to the sector's volatility. Technology companies often drive the strongest returns during bull markets, so having exposure ensures participation in long-term upside, even if other sectors temporarily lag behind. Healthcare, on the other hand, offers consistency and resilience. People need medical services, treatments, and pharmaceuticals regardless of economic conditions, making healthcare one of the most defensive sectors in the market. When recessions hit or when consumer spending declines, healthcare companies often hold steady or even grow because demand for health-related products does not drop. This steady nature balances the volatility of tech and provides a stabilizing force within a diversified portfolio. As global populations age and medical innovation accelerates, healthcare becomes not just a defensive allocation, but also a long-term growth driver. Energy contributes another layer of diversification because its market cycles differ from both technology and healthcare. Traditional energy companies fluctuate with oil prices, geopolitics, and supply and demand dynamics, while renewable energy companies grow with global climate policies and sustainability trends. This sector behaves differently from the rest of the market because energy availability affects every industry. When global demand rises or when geopolitical tensions disrupt supply, energy prices increase and benefit companies within the sector. Meanwhile, renewable energy continues expanding due to long-term environmental goals, technological improvements, and government incentives. Having exposure to both traditional and renewable energy gives investors stability from essential services and long-term upside from global transition to cleaner power. Digital payments add another unique element to diversification because they grow with global commerce, financial inclusion, and the shift from cash to electronic transactions. Payment companies benefit from every online purchase, every business transaction, and every subscription renewal. Even when economies slow down, people still need to buy food, pay bills, and make essential purchases, allowing payment processors to maintain steady revenue. During economic expansions or bull markets, consumer spending rises sharply, boosting payment volumes and increasing profits. This creates a sector that performs well in both stability and growth phases, making it an important piece in a diversified investment approach. Cybersecurity is an increasingly vital sector because it grows independently of economic cycles. Cyber threats, hacking attempts, data breaches, and digital attacks do not slow down during recessions. In fact, they often increase as businesses become more vulnerable. Every organization, banks, hospitals, governments, corporations, small businesses, is expanding its digital footprint, which increases the need for advanced security systems. Cybersecurity spending is not optional, it is a mandatory expense in the modern digital world. This makes cybersecurity one of the most reliable long-term growth sectors because demand rises continuously as technology evolves. By including cybersecurity companies in a portfolio, investors gain access to a sector that maintains stability during downturns and accelerates during technological growth cycles. These sectors do more than provide individual opportunities. They complement one another. Technology drives innovation and long-term growth. Healthcare provides stability. Energy creates cyclical opportunities. Digital payments mirror global economic activity, and cybersecurity ensures protection of digital infrastructure. Their different risk profiles, market behaviors, and revenue patterns work together to smooth out volatility. When tech stocks drop due to rising interest rates, healthcare and cybersecurity may hold steady. When energy prices rise due to shortages, energy stocks surge, even if other sectors slow down. When consumer spending rebounds, payment stocks benefit, and when digital transformation expands, both tech and cybersecurity grow. This interconnected balance ensures that the entire portfolio does not move in one direction at the same time. Diversification also protects against unpredictable global events. A supply chain crisis might hurt manufacturing but boost cybersecurity demand. A pandemic might damage travel and retail but drive growth in healthcare and digital payments. Inflation might pressure tech valuations but benefit energy producers. Economic slowdowns might weaken consumer businesses but strengthen stable sectors like healthcare and essential services. No investor can predict which event will occur next, but diversification ensures resilience against whatever the future brings. Another benefit of diversifying across these sectors is capturing multiple megatrends at once. Artificial intelligence, renewable energy, aging populations, e-commerce, digital transformation, and online finance are all long-term forces that will shape global markets for decades. By investing across these areas, investors place themselves at the intersection of the most powerful economic changes of the future. Instead of relying on a single trend to drive results, they benefit from multiple engines of growth working simultaneously. Diversification also reduces emotional decision-making. When an investor holds only a few stocks in the same sector, a downturn can trigger panic and lead to impulsive selling. But when a portfolio is diversified, one sector's decline is balanced by another's strength, reducing stress and helping investors remain patient. Emotional control is one of the most important factors in long-term investing success, and diversification naturally encourages that discipline. Finally, diversification allows compounding to work more effectively. Different sectors grow at different times, creating a smoother, more consistent upward trajectory for the portfolio as a whole. Instead of waiting for one sector to recover, the investor benefits from whichever part of the portfolio is currently performing well, allowing overall returns to compound steadily over years and decades. This balanced growth reduces the impact of bear markets and strengthens results during bull markets, making diversification one of the most reliable and proven strategies for building long-term wealth. The rise of renewable energy is no longer an abstract concept or a distant future ambition. It is a structural shift reshaping global markets, capital flows, and long-term investment strategies. As countries commit to aggressive climate targets and corporations accelerate their own sustainability transformations, the demand for clean energy solutions is growing at a pace the world has never seen before. This shift is creating new winners across multiple industries, from solar and wind to battery storage, hydrogen, electric vehicles, and the entire infrastructure ecosystem that supports them. The transition isn't just about replacing fossil fuels. It's about redesigning the world's energy backbone with smarter, cleaner, and more resilient systems. Investors who understand this transformation early will be positioned to benefit from decades of growth as renewable energy becomes the dominant global power source. One of the strongest drivers behind this long-term trend is the rapidly declining cost of renewable energy. Solar and wind have become cheaper than coal and natural gas in many regions, making them the most cost-effective option for electricity generation. As technology improves and economies of scale expand, the cost continues to fall, meaning countries no longer need to choose between environmental responsibility and economic feasibility. This economic advantage is why Governments are massively subsidizing solar farms, wind projects, and energy-efficient technologies. For investors, lower production costs translate into higher margins, faster adoption, and sustained demand for the companies operating in this space. The cost curve continues to move downward for renewable technologies, which means that even if subsidies decrease, the growth momentum is likely to remain strong for years. Battery storage is another powerful catalyst in the renewable energy boom. For decades, the biggest challenge with solar and wind was intermittency. You only get electricity when the sun is shining or the wind is blowing. But with the leap in battery technology, especially lithium-ion and upcoming solid-state batteries, renewable energy can now be stored more efficiently and deployed when needed. This technological breakthrough changes everything. It allows utilities to integrate renewables into power grids more reliably, reduces the dependency on natural gas for backup power, and supports the growth of electric vehicles. Companies involved in battery manufacturing, mining of critical minerals like lithium and nickel, and advanced battery research stand at the forefront of this shift. The expansion of large-scale battery storage creates a huge opportunity for investors as energy systems become more flexible, decentralized, and sustainable. Electric vehicles also play a central role in the renewable revolution. As nations move to phase out combustion engines, EV adoption is accelerating rapidly. This trend boosts demand not only for EV manufacturers, but also for charging infrastructure companies, battery producers, renewable energy providers, and software platforms that manage energy efficiency. EVs are more than cars. They are mobile energy storage units integrated into a broader clean energy ecosystem. Countries like China, the US, and major European economies are pushing aggressive EV policies, and as consumer demand grows, so does the entire supply chain behind it. Investors who identify the strongest nodes in this supply chain are likely to benefit from multi-decade growth. Hydrogen, especially green hydrogen produced using renewable energy, is emerging as one of the most promising solutions for industries that cannot rely on solar or wind alone. Aviation, heavy shipping, steel manufacturing, and long-distance trucking all need high-density energy sources, and hydrogen fits this requirement. Governments are pouring billions into hydrogen infrastructure, and major companies are racing to scale up production. Although still early, hydrogen has the potential to become a trillion-dollar industry, and early investors often gain the most significant rewards when an industry transitions from experimental to mainstream. As electrolyzer technology improves and renewable electricity becomes cheaper, hydrogen could become a central pillar of global energy systems. Grid modernization is another underappreciated investment theme connected to renewable energy. Power grids built decades ago were not designed for decentralized energy sources like solar rooftops, wind farms, and energy storage systems. To integrate these new technologies, grids must become smarter and more resilient. This involves upgrading transmission lines, building digital monitoring systems, installing smart meters, and adopting grid balancing software. Companies developing grid technology, transformers, semiconductors, and power electronics stand to benefit immensely from this modernization cycle. Energy grids are the backbone of the renewable future, and trillions will be invested worldwide to upgrade infrastructure and prevent power instability as renewables dominate the energy mix. Institutional investment is accelerating the renewable transition as well. Pension funds, sovereign wealth funds, and major asset managers are shifting capital from fossil fuels to clean energy projects. This isn't only about environmental responsibility, it's about long-term return profiles. Renewable energy projects, especially solar and wind farms, can offer stable cash flows similar to real estate. Investors seeking predictable long-term returns are increasingly turning to these assets. As more institutional money flows into the sector, valuations rise, research increases, corporate partnerships strengthen, and technological development accelerates, creating a reinforcing loop of growth. Emerging markets are also contributing to this surge. Countries in Asia, Africa, and Latin America are adopting renewables because they are cheaper to install than building new coal plants. Rural electrification projects increasingly depend on off-grid solar solutions, creating new demand for solar panels, inverters, and energy storage. For many developing countries, renewable energy offers the quickest and most affordable path to electricity access, which amplifies global demand for the entire renewables supply chain. As solar and wind continue to dominate new power installations globally, companies positioned in these markets have massive long-term growth potential. Another important factor is corporate demand. Large companies, tech giants, retail chains, manufacturers are committing to 100% renewable energy targets. To meet these goals, they sign long-term power purchase agreements with renewable developers, guaranteeing revenue streams for decades. This alignment between corporate sustainability goals and renewable expansion creates a stable and predictable demand environment for the entire clean energy ecosystem. Companies that build solar farms, operate wind turbines, manufacture renewable components, or manage energy software benefit dire. CTI from this corporate push. The renewable energy transition is no longer just an environmental movement. It is a global economic transformation accelerating through policy support, corporate adoption, technological advancement, falling costs, and massive investor capital. It is reshaping transportation, housing, manufacturing, energy storage, and even the financial markets themselves as trillions move toward cleaner and more efficient systems. Investors who understand these interconnected forces will be better positioned to capture the opportunities arising from this historic shift in how the world produces and consumes energy. The global shift toward digital finance is transforming how people save, invest, borrow, and move money, and this transformation is accelerating at a pace that is reshaping entire industries. The next bull market will be deeply influenced by companies operating in digital payments, fintech platforms, online banking, blockchain infrastructure, and financial automation. What was once handled through traditional banks and physical branches is now increasingly done through smartphones, decentralized networks, and cloud-based systems. This shift is not temporary or cyclical. It's a long-term structural evolution driven by younger generations, technological improvements, and the growing need for faster, cheaper, and more efficient financial services across the world. Investors who recognize the scale of this shift early will benefit from the exponential growth digital finance is expected to experience over the coming decade. One of the biggest drivers of digital finance is the rapid growth of cashless payments. Digital wallets, contactless transactions, QR payments, and real-time transfers have become the default method of payment for many people globally. Countries like China, India, and Brazil have already shown what happens when digital payments scale to massive populations, and the same patterns are emerging worldwide. Even in developed markets, contactless card usage and mobile wallet adoption have skyrocketed. This shift is pushing traditional banks to modernize their systems and fueling the rise of new players that specialize in frictionless digital transactions. Companies in the payments ecosystem, from processors to gateway providers to mobile wallet apps, are benefiting from a massive global trend that will continue for decades as the world moves toward a fully digital financial environment. Another powerful force behind digital finance is the expansion of fintech lending platforms. Traditional banks often move slowly, demand extensive paperwork, and use outdated risk models. Fintech lenders, on the other hand, leverage data analytics, AI, and automated verification to approve loans faster with more precision. This trend is transforming personal lending, small business financing, mortgages, and even credit card alternatives. Millions of consumers and entrepreneurs who were previously underserved or rejected by banks are now gaining access to capital through digital platforms. Fintech lending not only expands financial inclusion, but also attracts investment because of its scalability and asset-light business models. These companies can serve huge customer bases without building physical branches, which increases profitability and accelerates adoption. Blockchain and digital assets also play a major role in the evolution of financial markets. While cryptocurrency prices are volatile, the underlying blockchain infrastructure is becoming deeply integrated into global finance. Banks, stock exchanges, governments, and corporations are adopting blockchain for settlement systems, cross-border payments, supply chain tracking, identity verification, and asset tokenization of assets, turning real estate, bonds, commodities, or even art into digital tokens, opens the door to fractional ownership and 24/7 trading, something that was not possible with traditional systems. This infrastructure reduces costs, minimizes intermediaries, increases transparency, and enables instant settlement, making it attractive for both institutions and startups. Investors who focus on companies building blockchain infrastructure rather than speculative tokens are positioning themselves in an area with massive long-term potential. Open banking is another key factor in the rise of digital finance. In many countries, regulations now require banks to share customer financial data securely with third-party apps if the customer grants permission. This allows fintech companies to build smarter budgeting apps, more accurate lending tools, personalized investment platforms, and enhanced financial analytics. Open banking puts consumers in control of their financial data for the first time in history, allowing them to move between banks, apps, and tools seamlessly. This shift increases competition and forces banks to innovate, benefiting tech-focused financial companies that offer smoother, faster, and more personalized services. As open banking evolves into open finance, where insurance, investments, pensions, and mortgages all become interconnected digitally, the opportunities for fintech companies will expand even further. Digital investing platforms are also becoming mainstream. Fractional shares, robo-advisors, automated retirement planning, and zero-commission trading have democratized investing worldwide. People no longer need large amounts of money or financial knowledge to begin investing. They can start with a few dollars and a smartphone. Younger generations who prefer digital-first services are rapidly adopting these platforms, creating long-term growth for the companies behind them. As more people in developing countries gain internet access and financial literacy increases, digital investing platforms will see exponential demand. This is especially true as global markets become more interconnected and individuals seek alternatives to traditional bank saving accounts that offer low returns. Artificial intelligence is transforming digital finance from behind the scenes. AI-driven fraud detection, algorithmic risk modeling, automated customer service, financial forecasting, and identity verification have become essential tools for modern financial institutions. Fraud once required manual investigation. Now AI systems analyze billions of transactions in real time to identify suspicious behavior with remarkable accuracy. Customer service that traditionally required large call centers is increasingly handled by intelligent chatbots capable of solving issues instantly. These efficiencies reduce operational costs and increase customer satisfaction, making AI infrastructure companies and fintech developers significant beneficiaries of the digital finance trend. As AI becomes more advanced, entire financial workflows from underwriting to portfolio management will become automated, enhancing the scalability and profitability of digital finance companies. Cross-border payments are also in the middle of a major revolution. Traditional international transfers were slow, expensive, and burdened with intermediaries. Digital platforms powered by fintech and blockchain can now move money across borders in seconds at a fraction of the old cost. This transformation is vital for global businesses, freelancers, and migrant workers who rely on fast and affordable transfers. Remittance-focused fintech companies are expanding rapidly, especially in Asia, Africa, and Latin America, where traditional banking systems remain costly and inefficient. With globalization and remote work increasing, cross-border digital payments are expected to grow significantly over the next decade. Cybersecurity is another critical pillar of digital finance. As more money flows digitally, protecting data, transactions, and user identities becomes essential. Cybersecurity companies that provide encryption, authentication, network protection, and fraud prevention are seeing increasing demand from banks, fintech platforms, payment processors, and governments. The rise of digital finance automatically increases the importance of cybersecurity, making it one of the most stable and long-term investment opportunities in the financial ecosystem. With every additional user entering the digital financial world, demand for security infrastructure increases proportionally. The growth of digital finance is not just a technological trend. It is a global economic restructuring driven by efficiency, accessibility, and innovation. As digital payments scale, blockchain infrastructure expands, fintech lending grows, open banking evolves, and AI transforms risk management and customer service, the entire financial system shifts toward a more open, interconnected, and automated future. Companies positioned at the heart of this transformation will benefit from massive long-term demand as the world continues moving away from traditional banking and toward a fully digital, decentralized financial ecosystem. Remember, bull. Markets don't reward the person who moves last. They reward the person who prepares first. If you're still watching, you're already ahead of most investors. Now it's your turn to take action. Keep learning, keep researching, and keep positioning yourself for the future. Because the next bull run is coming, and the people who prepare today will own tomorrow.